first of all, just want to welcome everybody to our panel today. I'm Louis Topper, head of product at Allraise. Before we get started, just want to cover a couple of housekeeping items, couple of elements of the webinar. You can use the chat function to introduce yourself to others in the call if you like. If you do have a question for our panel, please put it into the Q&A box. We have a number of questions already prepared that we're going to go through, and a number of you have already submitted questions earlier, so then we're going to try to get through those as well. But yeah, thank you guys for being here, for fundraising in uncertain times. Excited for our panelists here. We have Jen Neundorfer from Jane VC and Maria Salamanca from Unshackled VC. And I think just to start off, would love it if you'd each introduce yourselves.
Yeah, I'm happy to start. First of all, thank you for having me. It's exciting to be here, and look forward to answering questions from the founders that are tuning in, because that's sort of why we're all here, right? And so I spent, just a brief background, I spent the first half of my career on the operating side in the digital media world, at startups. I was at YouTube in the early days trying to figure out how we made money. And then at larger companies, buying, scaling, and selling startups. And I jumped over to the investment side about 8 years ago, starting first focused on enterprise companies in the middle of the country, so software companies that weren't on the coast, really with an eye towards this sort of arbitrage opportunity, right? There were great companies in the middle of the country that weren't being looked at all by coastal VCs. 2 years ago, I started Jane VC with my partner Marin, who is a founder herself. It was sort of that same eye towards an undermet opportunity. And so our thesis at Jane is that women as an asset class and female founders are outperforming, but are totally underserved by the venture market. And so we invest at the early stage, so pre-seed and seed, in the women that we believe are building the next big software companies. We are investing out of our first fund. We have 19 companies in that portfolio, and we'll look to make another handful of investments out of that in the next quarter. So look forward to sharing more and sharing my perspective on what we've been seeing in the market in the last 2 months.
And I am Maria. Thank you again for having me. It's great to be here. I have been at Unshackled Ventures for 5 years now, since the very beginning of the fund. So I was the first hire after the 2 GPs started. So I think I missed only one investment out of the 42 or so that we have in our portfolio. But we also focus mostly on the pre-seed stage, and what pre-seed is. We can dig a little bit deeper into kind of how we all define pre-seed and seed, and it varies a lot. So definitely a topic that we can cover. Previous to this, I think I actually come from more of a law and politics career, and so I spent a good amount of time with a couple of campaigns, as well as I was the founder of this super PAC called Swing Left a while back. And so my experience actually from college and after college was a little bit more on the political side of organizing and strategic and fundraising for different types of campaigns. So that's where I come from, but landing in venture, have learned a ton, as well as seeing how much of what I've had previously in my experience is incredibly relevant still when you think through what operating early stages is like, and under-resourced, which is a lot of what local and state campaigns are every day.
Awesome, thank you both for those introductions. I'd love to kind of just open with hearing a little bit about what's on your guys' minds. How are you working through uncertainty and some of your priorities right now? And are you guys both open for business? Maybe Maria, would you like to start?
Yes, we are definitely open for business in a very serious way. I think the question of are you open for business is very stage relevant. And I think at the earliest stages of the pre-seed, angel, and to some extent seed funds that invest early in the seed, landscape, most of them are active. I'll speak for ourselves. We you know, in the hardest times in 08, 09, we saw some of the best companies be built, including like the Ubers and the Slacks of the world. And we did the Venmos and Square Cash, all kind of started in that time. And we see successful companies coming from very capital efficient times, and really good founders. I mean, if you think about the founders that are kind of persevering through these times to build a company, there's a different type of grit and focus and determination that comes from those type of founders that succeed from those times versus those that might come from a time when there's a lot of cash available for all kinds of ideas. And so we're very excited to invest in these times. And I think we have internally given ourselves a goal of doing like 18 to 20 investments by the end of the year. So at least the pre-seed stage, we really want to double down during these times. And you know, we're definitely open for business.
What Maria said, we are also open for business. I mentioned that, you know, we are at the tail end of Fund 1 and have had a series of closes on Fund 2. So we are beginning, so we basically need to finish deploying Fund 1, which means that we're really motivated to put capital to work in the next quarter, and then we'll be able to deploy out of Fund 2. And I think, you know, as Maria said, we also feel like there's a lot of opportunity, and you know, both from early stage companies and new companies, frankly, are in such a great position to read this new market and figure out where the new opportunities are and really take advantage of it. I think, you know, the other big thing that is on my mind, in addition to, you know, making great investments over the next 6 to 12 months, is really empathy for founders, because this is a hard time to be a founder. And I think there is so much conflicting advice for founders right now, you know, sort of things like, there's never been a better time to start a company, but by the way, it's also a really hard time to raise money. Or, you know, you need to cut your costs and really figure out how to survive the next 18 months, but you also need to grow. And so, you know, what we're spending a lot of time with our portfolio companies, and frankly with companies that are just broadly in our network or deals that we're diligencing, is trying to think through some of those conflicting priorities to figure out the right path forward for each company. And so, you know, I think that the message to all the founders on the line is that you guys are doing all of the really hard work right now. And, you know, at Jane, we really empathize with the difficulties that it is in leading right now. Also recognizing that there is a lot of opportunity, and we look forward to really hashing through a lot of that with founders to figure out the right path forward. Because, you know, as Maria said, constraints can really lead to some big, compelling opportunities. And we have no doubt that, you know, in the long term, we'll look back and realize that some really valuable companies were born in this uncertain moment.
Jen, I'd love to hear a bit about, you know, are you actively investing right now? Have you closed a deal? How many deals have you closed? And same for Maria next, in the last 7-8 weeks or so that we've been sheltering in place.
Yeah, so we just committed to a deal today, which is exciting. And we need to do one more reference call on another one, but we'll likely commit to a second deal by the end of the week. So we are investing. What I can say though, to just provide a bit more transparency and some color there is, you know, you asked about the last 2 months. So the first few weeks of March was definitely, we did pause on fundraising. And I think many funds did, partly because we needed to first connect with all of the companies in our portfolio and really work first to check in with them, make sure that we were supporting them, and really, you know, roll up our sleeves alongside those CEOs. Then there was sort of a week or two of communicating with our LPs. So, you know, what I would say is March was not our most active month because we were sort of dealing with the immediate realities of managing our portfolio and communicating with our LPs. It was also coincided with a close for our second fund. So what was nice was sort of emerging into April to either pick up discussions with founders that we had met pre-COVID or engage with founders that we were just meeting for the first time. And I mention that because I think there is a lot of question about, you know, who are who are VCs investing in? Are they just investing in people that they knew pre-COVID and had already been in their pipeline or were already in their network? And we have now gotten to the point where we're digging in on deals that maybe we knew before, or they're coming into us fresh and we haven't met them in person, but we're getting comfortable meeting them on Zoom and, you know, really developing some new ways to get conviction in deals, and are excited to have that process in place and begin deploying capital, you know, at a pace that matches sort of our pre-COVID pace.
Yeah, I think in the same timeline, I mean, we probably have done, and I would say 3 or 5 deals, TBD on like kind of which ones have fully closed. Some of our companies are print confirmation, so that takes a little bit longer, but I think the same sentiment across most funds was when all this happened, we all had to take a pause to spend time with our portfolio companies. And so really an assessment of which companies might need some extension money because they were about to go raise in the next 2-3 months. And we knew that that was probably not going to be good. And they were going to need some help and support, not because they're bad companies, but just because realistically, if they're going to raise seed or Series A, we definitely know those funds were not going to be active in March. So there's some assessment on where do they lie. Obviously, some companies were hit harder if they happen to be in, you know, hospitality, travel, anything like that. And some companies actually were in a position to do better in these times, and that tends to fall actually on consumer companies right now. We see a lot of consumer companies in our portfolio doing a lot better than they would have expected through normal growth. But, you know, obviously people are home and spending a lot of time online. And so we see some of these companies all of a sudden have higher demand. And sometimes that means like, do we need to raise faster? And that's also like a conversation to have. So in general, most VCs that take March to really reassess what's going on here and how do we need to help our portfolio companies. And, you know, I think there's always, every VC is always playing a double game of understanding also from our own portfolio companies upstream, what's the fundraising ecosystem like, right? So we know what we are like, but we depend on our portfolio companies to go out there and start raising to get some feedback on what does the new seed look like? What is the new Series A in terms of valuation and stage expectations and round size? And so a lot of those are things that based on that, obviously we have to adjust ourselves and what are we going to invest in? Because, you know, if seed expectations rise, then that also means that maybe we need to capitalize companies better, the ones that we're excited about. And so there's just a lot of figuring out internally, strategically, what does this look like, that I think obviously a lot of founders saw that there was a slowdown on response rate or just in how quickly deals were moving through if you were already in the pipeline. And it wasn't because VCs all of a sudden forgot about you. It was just like, let us figure stuff out so that we, at least from our end and our fund, we were like, before we take people's time, let's make sure that we gather our thoughts.
Awesome. I have so many follow-on questions. I would love to start speaking to what you both brought up, which is this idea that now we have a set of very interesting constraints for founders to be exploring. Could you speak a bit, Jen, to start, I guess, about what trends you're seeing in various industries and what interesting constraints are coming up that you're excited about?
That we're seeing, and it's particularly relevant on the consumer side, is, you know, for any new company, one of the biggest barriers in the early stages is to convince people to do a new behavior or use a new product and sort of adopt something. And that can often take a really long time. What we're seeing is that everyone being at home and virtual and remote is leading to the adoption of new behaviors much more rapidly in a way that creates some real opportunity for companies. And so, and I think, as Maria said, particularly on the consumer side, although, you know, also on the enterprise tech side. So as an example, we have a company that's all around, basically it allows Gen Z to really easily connect, share screens, integrate, and feel like they are in person with each other. They had rapid growth before, but now suddenly anyone who was on the fence about, do I see my friends in person or not, is adopting this technology. And so, that's, I think, one of the areas that we're seeing some really interesting ideas emerge. I'd say another area that's related is in sort of the healthcare space, whether it's consumer or on the more enterprise side. But, this is an area where not only have the behaviors changed, right? So in the matter of a couple of weeks, you have both providers and patients who are suddenly open to virtual connections, but all of the reimbursement laws have also changed. And so from our perspective, that's something that's, we're not going to put that back in the bottle, and that's here to stay. So whether that is, in the telehealth space or the mental health space, we're seeing a lot of really interesting opportunities emerge there. And then I would say, like, the final area that we're looking at a lot is in the e-commerce space, because as Maria said, like, one, there's some pockets of e-com that are really just taking off. I think there's, not surprisingly, others that are having a tough time, but we're also looking at some of the technology to enable e-com. So, realizing that as brick and mortar retail realizes it needs to move online, what does the e-commerce tech stack need to look like to support virtual commerce, which regardless, states are opening up and we'll see the impact of all of that. But our thesis is really that there's going to be waves of all of this, and, that the days of going to big box, retailers in mass is probably still a long way out. And that retailers will start thinking about how to build out the e-com tech stack to really scale and support a variety of use cases.
Yeah, I think all of that is definitely areas that we're excited about as well. And I think, I think the bigger question now also becomes, and what is that middle ground between everything's online and social world moves online to, we still miss a lot of the in-person and physical interactions and shopping and stuff, right? So, is this maybe the time when the VR AR experience finally takes off in different sectors? Might be one of those questions that we're thinking about. Obviously, it's had its beginning and start with gaming and other specific verticals on where a lot of AR and VR made sense. But what does the future look like? And are there specific platforms that are going to see more demand, like the right timing for the first time when you kind of ask companies why now? Some of these platforms are not going to have a very clear why now, and specifically long term. I think what I will say that we are also seeing that is not the best always is just because COVID is happening and your company happens to be in a well-positioned place where it doesn't mean, you still have to answer the question of, is this a long-term trend, right? Like just COVID times, obviously this is a new world moving forward, but investors are still also taking a step back and saying, is this behavior something that scales beyond these times? And obviously it'll work right now, but 4 or 5 years from now, let's say we do some more obviously integration back into whatever the new normal looks like, are we going to start seeing a dip? And I think a lot of entrepreneurs have really leaned into creating that COVID slide in their deck, and it's not necessarily a bad thing, but the next question is this a short-term growth spur or a long-term one? And some of the companies that obviously are getting huge rounds of funding right now that are benefiting from this, I have the same question for them on, obviously there's a huge demand, but is this going to be, are we going to match that demand, right? Like if you look at, public stock market and Zoom, not saying Zoom's not a great platform, and Zoom is obviously not going to be the future of video conferencing, but is the demand right now of pricing where it is? And so I think VCs are also making sure that they kind of check themselves on, let's not get too excited too fast just on the times.
Wonderful. Thank you both for that. This is a question that we had in advance, but also someone else in the chat has already asked this, or in the Q&A, Deepa Sureka, and I apologize that I'm butchering your name. Sorry about that. But just would love if you could both speak to what are your, during this time, what are your pre-seed expectations? What are your seed round expectations for companies so that the founders on the line can really have a criteria for how much more traction you're expecting, or you know, if revenue is a prerequisite across a certain industry. So Jen, why don't you start?
I'll share my thoughts where our heads are at. I think it's evolving, right? And that is a place where, you know, again, to the founder empathy, I think this is an area where there is still a lot of uncertainty. So, you know, our expectations for pre-seed really haven't changed, actually, to be totally honest, because, you know, pre-seed is so early to begin with. And at the pre-seed, what we are looking for is, you know, obviously the big market, right, that you're always looking for, but it really comes down to the people and the founder market fit around this idea, and why we believe that this team is not only the team to, you know, build this company, but this team creates some sort of unfair advantage for this team, or for this company. And so, you know, that is really like so much of the core of our investment thesis. Our pre-seed investments are generally pre-revenue. They're often pre-product. You know, there's often something there that we can look at, but it might be wireframes, or it might be, you know, held together with duct tape on the back end. So, you know, that hasn't really changed much. What I would say is that I think for founders that have raised pre-seed, I would be thoughtful about what endpoints you're trying to prove out to go after your seed. I think what I've seen in the last, you know, 5 years is that founders raise a pre-seed round, and then, you know, assuming that they have some sort of positive traction and their prior investors, you know, give them good references, it's generally likely that they'll raise a seed round. But I think this is a Darwinian moment in venture, just like 08 and 09 was. So I think that there will be more, you know, narrowing of the field from a pre-seed to a seed. And so, you know, it's hard to say across the board, but what I would do is pick the 1 to 2 metrics or hypotheses that you are going to, you know, ultimately prove out. So when you go to raise the seed, there's a coherent story around that. I don't think, you know, I still don't think seed investors are going to expect full product market fit. You know, I think that is still really the goal of a seed stage round. But I go into, you know, a seed having really good hypotheses about where that product market fit may be, so that there's a few key things that you test out with the seed, and then by the A, you really know where you're shooting, and the A becomes about, you know, scaling into that opportunity and really beginning to ramp things like revenue and unit economics.
Yeah, we think about it very similar. I mean, like 80% of our investments or so are pre-product, pre-revenue, and that's really kind of our sweet spot is, and what we consider pre-seed. I think what we expect to change is, you know, when we started the fund 5 years ago, our check sizes were similar to, if you think of who would be the OG like pre-seed investor, and you would think of Y Combinator at the time, and Y Combinator's checks were 120 back then. And we started with our check ranges between 150 and 200K. And that was 5 years ago. With time, as the market has evolved the past couple of years, our check sizes had to start getting bigger, because people went from saying pre-seeds are, you know, I think if Y Combinator represented a pre-seed, it probably meant that a couple of angel investors or another investor would come in, and a pre-seed round would be under like 400K. Like, honestly, the original pre-seed round was like your family and friends of $350,000. And at the end of this, as in like pre-COVID, we had pre-seed rounds that were like $1.5 million. And the stage of the company itself, right? Like being pre-product, pre-revenue actually didn't change, even though that size of a round was changing. And so what you found was that there was a lot of companies getting a lot of money without very specific focus or unique insights to build around. And then they would get to a seed with very little to prove, and just enough that you would still get some money at the seed and then get pushed. But you have a lot of companies right now and investors kind of holding what we call like the hot potato. And these are seed companies raising a Series A that are probably not going to do great because they raised too much money, they burned too fast, and it's unlikely they hit a lot of those Series A milestones. And so we are very excited to see back to normal times, in which we hope that the pre-seed round goes back to being that 500K type of round, because we see that that tends to be plenty, including for consumer companies, to prove out some of your very core key assumptions. The parts of your business that are the most hard to prove, right? So I'm thinking of one of my portfolio companies that was in the femtech women's health, and their initial kind of, they were going after the woman tracking of periods and all kinds of stuff in that space market, which we always know there's the clues and the glows and the flows. And their thesis was you actually need hardware. And they were like, we're not going to raise a seed when we know investors kind of hate hardware. And they had very specific insights about why hardware was important and what hardware provided them that none of the other apps could do. And that was something we could get behind at a reasonable size. And there was something that they were able to prove. And so going into seed has been a much easier path for them. And I think for all of our companies, we work very closely on like, what are 2 or 3 hypotheses that you have on what is the right way to build this company that will get you that growth and metrics that you'll need, so that we can de-risk you. So when you go to the seed investors, that's not a question anymore, right? Like the seed investors of today that are talking to this company are not asking like, do you really need hardware? Because they already proved that out. But that was also the riskiest part. And in an ideal world, the earliest stage investors are taking the biggest risk on you. When your early stage investors are giving you $2 million and expecting you to be a consumer company that goes and pays $20K for a branding agency, and then are okay with like 30-40% of your kind of budget going into customer acquisition and paid advertisement, you're not going to have very clean data or metrics of success at the end of that round. You're still going to have investors ask you, did you pay for this traction? Is this real traction? Is this a real pain point? And I think that on the consumer side, it is really, really important to prove out that you've done the right customer validation, that you understand, like think about all the things you can do on the consumer side before you ever write a line of code. And that goes into customer validation, customer segmentation, understanding of where in the value that you're creating, like what's the value chain and where are you really tackling and making a difference. Those kinds of questions are the ones that ideally you pre-seed, seed, or your first couple of investors are asking you in the early days. I think those are the kind of right partners for you, versus there's a lot of investors that are later stage and are used to later stage metrics that will be like, well, where's the product and where's the traction and where's the customers and where is the, like, what's the CAC and what is your LTV? And it's like, you're just starting. And there is a sustainable way of building a company and there's a non-sustainable way of building a company. And I think times are shifting back to the more sustainable way. And I actually think that's a good thing for consumer companies, because consumer behavior takes time. And there's no amount of money that you can throw into a seed round that in just 1 year you can prove out everything, because habits take time to build, habits take time to prove, and consumers just take time to figure out. And so I actually think that consumer startups long-term benefit from just slowing down the pace. And I think we'll see that in decreasing costs of ads and stuff like that as well.
His point, just around how early stage funds are used for consumer startups and sort of the amount available is so spot on. I think the days of spending to grow, and specifically spending just, sort of the sky's the limit spend to acquire customers are over. And that was actually happening pre-COVID. I mean, I think what's interesting, just sort of thinking about the consumer segment as a whole, is we started to see the contraction in consumer in the fall of last year. So, some of the consumer companies in our portfolio, frankly, their metrics were, they'd hit all the metrics that the Series A fund said, if you hit this, we'll invest. They went back to them and they were like, oh, actually, if you hit 2x that, we'll invest. And so you started to see this contraction. And I think a lot of that came from what we'd seen at the growth phase, right? Where, a lot of consumer facing companies were coming to market or, getting to a growth phase, coming to the IPO markets, and the economics just weren't there. But I think this whole trend of spend to grow without looking at the fundamentals of the business, that had already happened to consumer. And so, in a certain sense, I think consumer startups, particularly at the early stage, have already been reacting to that. And, now you see some of the enterprise startups trying to play catch up a bit post-COVID. But I think, I want to underscore Maria's point about really understanding, taking the time to test those key assumptions and not trying to spend too early on customer acquisition, because then I think you can get some false signals from the market. And, I think Maria's point that as round sizes come down, first blush, that might feel frustrating to founders, but that is a constraint that's going to actually build stronger companies in the long term.
Thank you both for that. Would love to dig a little bit further into talking about assumptions and hypotheses that the founders should be considering. I wondered if you could provide helpful notes in terms of how to be crafting or thinking about these hypotheses for the founders on the line. Maybe Jen, continue on.
And yes, so assuming that I understand the question right, I think the specific hypotheses are going to vary depending on the company, but I think really early on, it's important to start testing whatever it is that you think is going to be the differentiation of that company. And so what is it going to be that you do? What problem are you solving for what customer segments? And who is it that really cannot live without your product? Because I think what we're seeing across the board is that the best companies are selling painkillers, not vitamins. And obviously in consumer, there's a bit more shades of gray there, but the companies that we are excited to invest in are ones that very early on prove that consumers are evangelists of their product and can't live without their product. And so, there's ways to do that, right? Like, they don't all need to be, these early consumers that are using your product don't necessarily need to be fully paying, full freight consumers, or, maybe they are people who are using the product for free. Like, whatever that looks like actually isn't really important. It's what are they saying about the usage? Who are they telling about the product? What feedback are they getting? And, I think a lot of this comes down to knowing how to ask questions of your early users. So there's a real difference between asking someone, would you use this product? People often will say yes, versus some, sort of less binary questions like, how would you use this product? In what situations would this be an essential thing? Now that you've tried using this, how else could you see using it? Really dig in deep. And I think what is great is that's something, there's a lot of resources that you can easily find. And I'd be happy to share some after this call that we share with our founders about how to ask some of those questions to go beyond the real superficial answers that I think particularly on the consumer side you can get if you're not really being thoughtful about how you're doing that initial market discovery work.
Yeah, but I echo all of those. And I think, what's interesting about consumer is that, anything consumer defensibility is always inherently just almost non-existent, because it's very difficult to do that. It doesn't mean that there's not unique wedges to the market that allow you to build a long-term defensible company. And so I think this is where founders actually in the consumer space struggle the most in answering that question. Because I think a majority of them understand, the question that investors will probably throw back at you is, okay, we get the opportunity, we get the problem that you're going for, we get the solution you're going for, but like, why you? Like, why can't, four other people with incredible technical building background, branding, go to market, like you name it, consumer background build this? And I think that's where a lot of founders get stuck, and they're like, well, I guess technically anyone can build this, but it's about what unique understanding do you have about the user, the consumer, the product roadmap, the wedge into what you're trying to prove that's where the real interesting conversation comes from, right? That's where you say, look, obviously what we're building might not be at the very day one unique, but what we're trying to prove is unique. And the reason that we're trying to prove this is we have specific reasons why that's why we're trying to prove. And the reasons why those are the most important things to prove first are these. And that's a very different framework of a conversation to have, because it allows the investor to understand how you're prioritizing your de-risking roadmap, right? There's always a product roadmap, and there's always a business model roadmap, and there's no right answer for what's the right way to do that. What the investor is looking for is your understanding of the consumer or the product to tell us why is this feature first, right? And especially when your feature, when we look at so many consumer app decks, there's 700 features on it. And, one of my favorite questions to ask is always, if you had no money for any more than 2 features, which 2 features would it be? They'll be like, no, that's impossible. Like, the product is entirely one full thing. We need all these features. And I'm like, no, like there's always a couple there's always like a value, a specific feature or part of a product. And you need to really, really narrow that down, because in times like now where money is constrained, these are the things you have to build for, right? You're raising to build very specific things, right? So you're not going to get $1 million to build 20 features and go for 20 different markets. You're getting money, you're getting 300K to really build out and prove 2 features that you're going to prove out why those are the most important ones. And so it's about, the reason why we think about this time as a good thing for consumer founders is because it really emphasizes scarcity mindset, not just in terms of money, but in terms of features, in terms of what you need to prove, and how you go to your users. And so we think that that's the opportunity that is there, and those consumer conversations can be a lot more valuable if, like we said, before you ever write a line of code or hire 10 engineers to build a product, you have answers to those questions on what is the core value of certain parts of the product or parts of the user experience, the user behavior. And a lot of that requires, like Jen said, really asking the questions the right way from the users, because it's easy to get bad, noisy data from a lot of consumers. So defining who your actual consumer target segment is the most important, because if they're the only ones that matter or are willing to pay, they're the only ones who you really want to be focusing on. And I think that it's okay for consumer companies to just say no to everyone else who does not fit that criteria at the beginning. And you're focusing on one segment that has high willingness to pay and is eventually going to be that winner for you. And it's okay to not just say we have every woman that is 18 to 45 in our platform at pre-seed stage. We get the vision, we know where you'll be eventually, but we need intense focus in the early days.
So it sounds like a lot of customer discovery upfront, hyper-focused, as opposed to going broad in defining that target segment. And I love how you put kind of the refinement on the wedge, and then how the wedge unfolds. What's your roadmap with that specific wedge, as opposed to here's like everything all at once and we're going broad. Really helpful. Moving back into, we kind of went down a thread there. Fundraising tactics. It sounds like people should be fundraising, expect smaller checks, probably smaller valuations to an extent. Are there any guidelines that you can recommend for founders regarding the timeline of running a fundraise process? And maybe speak to have the timeline involved with closing rounds also changed? Jen, I don't know if you'd like to start.
Are taking a bit longer to get done. So I can just, my anecdotal experience is that it's particularly around, there's 2 things that I think are driving that. One, I think there are a number of funds that are taking meetings, but maybe not actually ready to invest. And so that just slows founders down. And so I think it is really fair for founders to be straightforward in asking funds, where are they in their fund cycle? Have they, are they making investments? Have they made investments in the last 8 weeks? There's a respectful way to get some of that information so that founders can figure out how to prioritize the different funds that they're working with. So we've talked to a few that are, think they're getting really far with one fund that they're kind of waiting for, and then it turns out that that fund actually isn't ready to move quickly, and that has slowed down the pace. I think there is also a bit more time to hash out some of the terms. I do think this is a tricky environment to price things in, because, to give some insight into where the funds are, no fund wants to price a deal today and have it be overvalued in 6 months. And I think, without quite knowing what's going to happen to the long-term market, that is a risk. And so people are being more thoughtful. We've talked to a few funds who are bridging their current companies and basically said, we're not going to do any markups. We're going to bridge you at your past valuation. And that may be generous, or it may be, undervaluing you, but we're just going to do that so we can get this done quickly. And so I think those are the things that I'm seeing that are driving the timeline a bit. And so, I think founders should be prepared for that. It's tricky. Should founders be raising or not right now? Part of that is going to be, do they have to raise? So if you have to raise, you have to go out and raise. I think there is a different strategy of taking a smaller round right now. And, what we're seeing a lot of companies do is put off the A. And basically doing a seed extension and waiting, because I think I think deals are getting done at the pre-seed and seed stage. So for most of the founders, I think on this call, it seems like people are pretty early. That is good news. I think the investors that are writing checks, and now 2 months has gone by, it's going to be easy enough for you to talk to people in your network to see who actually is writing checks. Those people will continue to write checks. I think the Series A is a bit more murky, because there a lead investor is writing, $4 to $5 million lead check. And I think they are more hesitant to do that without meeting people in person. At least that's what we're seeing. And so, there are some funds that I think are working through that and, are getting comfortable with remote. But that is another bottleneck that we're seeing some companies, for those of you that are a little bit further along, we're seeing some companies who will raise a bit right now because they know it's going to take, either longer to raise, let's say a seed round, or they're going to try for an A, but not until the end of the year when hopefully things have settled down a little bit.
Yeah, I think, we're seeing a lot of this. We're going to bridge you. We're going to give you a flat round as well. And I think investors themselves are asking, is this flat round overpriced? But I would say, and seeing some of our own portfolio companies going into raise, we saw that any of our portfolio companies that were mid conversations were able to close their rounds fine. I think if you're already in the pipeline, they already met, that those moved along, and not as quickly as they would have usually. They still literally closed in the past couple of weeks when the conversation started a while back, but they closed fine because they did have a chance to be in the pipeline before. Those that are just starting, focus is super important when reaching out to funds. So in the case of a seed, we're telling you only talk to funds that can be leads, because everyone, it's hard in a time like this for anyone to have conviction, period. And be the first check-in. It just takes a lot of guts to be that first check-in at the early stages. And the only funds whose entire job is to be that first check-in conviction is those lead funds. And so when it comes to seed and pre-seed, it's kind of cleaner to know who's institutional pre-seed fund that leads or likes to own most of the round, if not half of it. It's about focus on those conversations first before you spend time with other funds that might do smaller checks, follow, or angel investors that also just kind of follow, because it allows you to go through the cycle. And I would say, try to tier them as well, right? Have a couple funds 1 week that are a mix of top tier and not top tier, then do it through a couple of weeks so that you get enough time diversity in your fundraising where you get feedback loops on, okay, these funds seems to be falling here. East Coast and West Coast seems to be like, this is the feedback we're getting. You have to learn so much from the process. What I really try to tell founders to do is don't overshop yourself too fast. Because if it just happens to be like having fundraising 2 weeks ago was a totally different world than starting to fundraise this week. Like seed funds are all were like pretty much shut down 2 weeks ago versus this week they're like, okay, we'll start taking some meetings. But if you literally went all in and sent every intro email and every call during that week, it's likely that you like just we're not going to get a lot of traction. Or just give yourself time in uncertain times. Give yourself diversity of time. Like just you need like to spread out those conversations. And once you have a good first, second meeting with a couple of those lead funds, then start rolling out your follow-ons, because at the very least you can say we are in conversations later stage with a couple of these seed funds, and they're, you know, even though it's not fully closed, at least these follow-on funds can see that you're worth of having that GP1 GP2 conversation, and there's likely something that they're seeing in you that maybe they're willing to have that conversation. So it's about how do you create that momentum in times like this when everyone is incredibly uncertain and lacks conviction. And it's about definitely spreading time, spreading the kind of geographic diversity you have. Try to like just take it slow. And my estimate is that it's going to take like 6 or so months to close some of these rounds, even for good companies. I think it's just taking a lot of time because even a pass right now might not really be a real pass, and you might have investors come in a couple months and say, let's talk again. So it's just a little bit messy, and I think it's messy all around, both for investors and for founders. So we apologize on behalf of the industry.
Thank you both for that. So this was a question from one of the audience members wondering, do you see challenges specifically for women during this time receiving funding, especially if they're taking on additional responsibility at home?
Yes, absolutely. I think I wish there was a different answer, but in times like these, and this is not just happening for founders, it's also happening for venture capital funds. So VC funds that are raising right now in the emerging manager category, LPs or investors in funds tend to double down in funds that they have a track record that they've known for, you know, their vintage fund 7 and 8, and they know kind of what that looks like because they're trying to put money in safe places. And I don't think that's so. That means that the funds that are led by probably the emerging managers or the non-white middle-aged men are the ones that are going to have a lot of cash for a decent amount of time. And some of the funds that are kind of more of the up-and-coming, emerging, exciting, like, you know, women funds that a lot of women entrepreneurs go for are probably going to start fundraising in these times and taking some time as well. So there's going to be that delay from the upper end that's going to push down just thinking of diversity of funds and who you go to as a woman founder. A lot of the funds that are like your ideal fund might be impacted more than not. On the founder side, I think that the same thing happens at seed and Series A, where investors obviously are going to be leaning towards safer. So founders, like second-time founders, people from their own networks, just because they, you know, if I'm not going to meet you in person, I at least know maybe like I have some mutual connection, something like that. And I don't imagine that there's not going to be some of turning back into those old ways, unfortunately, which I think it's why it's also important just to know who in your list of funds of who you're talking to, always kind of figure out, you know, when was the last actual fund that they raised? Are they going to be raising soon? Do they have capital to deploy? As well as just thinking through, are these the kind of, like, based on their portfolio, do we have an understanding of what kind of founders do they invest in? Sometimes it's very easy to go to fund portfolio things and know if there's like a pedigree factor, right? There's some funds that are like very Stanford funds, and just a look through their portfolio, you can just tell. And not all funds are like this, but just doing that additional research sometimes will help you save a lot of time.
unfortunately, I agree with Maria's sort of overall point. I think this does hurt sort of underrepresented founders, or that's the risk, right? And so we actually just did this study 2 weeks ago, looking at early stage founders, and there is, a lot more pessimism and sort of reluctance about the fundraising market among early stage female founders than there is about, male founders. And, I think one of the phrases that we're hearing, Maria, I don't know if you're hearing the same phrase, is flight to quality, which is sort of like this, in my mind, is this like terrible euphemism for we're going to go back to the people that are already in our networks. And again, like if you're not going to make the effort to figure out how to use Zoom and other channels to really get to know founders and sort of emulate an in-person connection, then you're going to go back to the people that you already know. And, presumably that is not given what traditional venture looks like. I think, that means that a lot of great founders who are women or, founders of color or founders that don't live in the Bay Area, like I think that is going to hurt them. And so, there are funds that are focused on finding those founders. So I think to Maria's point, go out and find those funds that are looking for you. Ask the questions to make sure that they are investing and that it's a good use of your time. But I think the other thing that we are thinking about, and that I think you guys can all think about, is like the right way to make virtual introductions and how to make those feel warmer, so that if investors are saying, we really need to get to know these people and just meeting them on Zoom isn't enough, like we've thought about, as our companies go out to raise follow-on capital, do we actually join them on the Zoom with an investor that we're putting them in touch with and sort of simulate a warm in-person intro and things like that, I think can help overcome some of the virtual boundaries. But I do think it's a risk. And, it's sort of, for us at Jane at least, and I'm sure for Maria at Unshackled, it really underscores, why we're so committed to the thesis that we have.
Really helpful, thank you. So there are a number of founders who are in the call that are kind of wondering what your takes are on industries that are impacted by COVID, restaurant, in-person retail, travel industries, industries that may require some level of in-person interaction. And I think they're looking for a temperature check on what your investing stance is in the short term and long term for these industries, given that they will recover at some point, but would love your input on that. Maria?
Sure, I'll go first. It's hard to say like one big rule that covers everything, because it really is so dependent on the team and so dependent on the company. I think overall, obviously, the biggest concern with industries that are heavily impacted, whether it's hospitality or travel, is just sales cycle, right? And so the question for most investors will have is, are you going to have enough feedback loops time-wise with the money that you're raising to prove what you need to prove for that next round? And if the answer is no, then it's very likely that that's going to be a pass. And because the question is being like, how many customers are actually going to be able to pay you in the next year? All right, like let's say you're raising a seed round. I think most funds right now for seed rounds are encouraging founders to raise from 18 to 24 months. I've even heard some funds say raise for 3 years. And that's insane, right? Because that they're giving themselves enough time to say, okay, let's just assume that the next year just sucks and you're just going to be heads down in product and building and doing some validation, but knowing that there's no money going to come in. They're really going to bet on you having enough runway and a incredible enough team to be able to make the most out of the runway that they do give you when there is not money coming in, or when the sales cycle is long, or when there is no clear timeline of when you're going to start getting some customer segmentation, validation, like insights. Like it's harder from the investor perspective, because I can be incredibly bullish about the future of travel, or the future of in-person retail and like physical community spaces. But I have no understanding of the timeline of what that looks like, and more specifically of what the pockets of small businesses are going to look like. And so I'm counting on timeline, right? So I'm counting from when do you need to raise next? And let's say you're raising for 12 months. It's very unlikely that I can get conviction around in the next 12 months. Not only are you going to have to prove all these things product-wise and business-wise, but you're also going to have to wait for your customers, let's say small businesses, to have enough cash to be open to taking on new stuff, right? Versus the bare minimum of what they have. And so it's about what is that budget share size that you're taking, and when does that open up again for you? And so it's a question of timing. I think VCs will say, look, we don't think planes are going anywhere, right? We don't think like small businesses are going anywhere long term, but it's about like just timing, right? There's going to be a lot of incredible companies. I mean, if we think like the Airbnbs of the world are struggling, and not because it's not a real business, or it's not a venture fundable business, or it's not an incredible team, or they don't have enough investors that want to give them money, but because it's just bad timing. And so unfortunately, I think as a founder, you have to answer the questions of, you have to have a clear understanding of when your customers will have money, when they'll have the willingness to work with you and do those feedback loops that you need to learn to prove stuff. And how much money do you realistically need to prove everything you need to prove by next round? And I think what I would say is, if you are an industry that is overwhelmingly impacted by COVID, your minimum amount of raising should be for 2 years, like minimum, and push a little bit further if you can. Because there's a chance that the first year there's nothing that gets done. And so what does that mean for your team? It shouldn't mean, okay, well, that means that we're going to raise a $5 million seed, because that's not the climate today. It just means that you're really going to have to cut down, and like, how do you make $2 million last 3 years? It's going to be the question that some founders are going to have to come to terms with. What does that mean for your team? What does that mean for your product? And do you really love what you're building so much that you can do $2 million for 3 years? Is kind of that uncertainty part of where we're at.
To when will your customers have the money to pay you? It's like, when will they have the bandwidth to engage around something new? So again, back to that like painkiller versus vitamin. If this is something that is like an essential thing for restaurants or, you know, the hospitality industry, like maybe there's a chance you get their mind share. But if not, I think it's, you know, it's probably a year before they start looking at anything new. So I think that's another thing I take into account.
Super helpful. We have around a minute left, and I just want to be mindful of time and maybe just give you each a moment to give kind of parting advice. I know you shared your emails, which is lovely for founders in the chat to be able to reach out. But maybe there's just one note of advice that we maybe didn't cover yet that you each would like to share as a closing thought.
Someone I think had asked a question about goal setting, which is really hard because everything is changing so quickly. And so I would encourage people to set short-term goals and constantly reprioritize and recast goals, right? And so you're not changing what your overall endpoints are that you're shooting for, but you're being realistic about a changing landscape around you, and, you know, are course correcting and not trying to unrealistically set goals for a year from now that may or may not be relevant. So that's the first piece. And then the other thing that I'll just mention, you know, for some of the startups who are well capitalized or are, you know, are seeing a bump given the current environment, is this is a really great time to hire very experienced talent. There are just so many wonderful people on the market right now. And, you know, I know all of you guys are early. You're not going to go out and build, you know, 20-person teams, but there are people who have not been on the market. There hasn't been a hiring market like this in 5 to 7 years. And that could really play in your advantage as you look for all-star people to be, you know, number 2, 3, or 4 to your team.
Yeah, there's a lot of fantastic startups that are doing layoffs, not because they're a bad company, or they just happen to be in the wrong industry, right? Really good talent. I think the other one is, I love consumer in general. I'm always very excited about consumer because I think that that's part of the market that tends to just kind of carry us through in really tough times. Always, there's just such innovation on the consumer end in very tough times. And the question is just always just, don't be afraid to think big about what does that world look like in a couple of years on the consumer side. I think try to not just focus on what has worked, right? If you think about D2C brands, or you think about what kind of branding playbooks were out there, because so much of that is going to be kind of scratched based just on the economic circumstances of where those companies came from versus now. And so this is a time when new playbooks are going to be written about consumer landscape and social, and there's different infrastructures now that we didn't have 5-10 years ago, whether it's in the VR, AR space, or you name it, that will open up a lot of opportunities. And so I mean, constantly push yourself to make sure you're building a company of the future with not being afraid of new playbooks, that maybe you might be the first one to do that playbook. And if you have the right investors behind you to see that that's something that makes sense, that's great, versus kind of using old playbooks that, this company raised, like Allbirds raised all these millions of dollars, being Allbirds, why can I? And there's 100 reasons why that's the case. And it doesn't mean that you're not equally as good as a company as Allbirds, but there's a lot of macro trends that are completely out of your control. But that we all are aware that it's just not those times anymore.
Awesome. I want to thank you both and for joining us today. From the crowd, big round of applause for our panelists. I know nobody can see you, but thank you both, and apologies for panelists. We weren't able to get to all of your questions, but I will follow up. We'll follow up with an email. Jen, perhaps you can share the questions that you have founders ask. That was a follow-up question from players in the audience. But I just hope everybody is staying safe and doing things to care for themselves during this time. But thank you both.
Great. Thank you all. Have a good one.
Guys.
Bye.